The bond market is showing some troubling signs as interest rates rise and inflation is still running hot. Craig Bolanos, the CEO and founder of Wealth Management Group, is here with some common sense. And Craig, what do investors need to know?
Well, it certainly has been a tough start to the year, but higher yields in the bond market means that there is now an opportunity for reinvestment at better valuations. And what does that mean? The future outlook for bonds has actually improved. So with fixed income markets this year having quickly repriced various Fed hikes this year, yields all across the Treasury curve have moved higher. And that, of course, put downward pressure on bond prices. But one of the positive characteristics of many fixed income investments is that we now have a fairly good idea of what to expect for prospective future returns. And that's what we call starting yields. And absent defaults, and they sure don't look likely, starting yields represent the best expectation for future returns regardless of what interest rates do in the interim. And typically after broad-based bond sell-offs, we've typically seen bounces in the months to come because of those higher, more attractive starting yields.
Do investors really need to be nervous, though, over these rate hikes and future increases?
Well, Angela, I think that's a great question. It's really spot on. But, it's important to note that the negative returns in bonds to start this year are because we're seeing yields moving higher, not because there's an increase in credit risk. And that's a huge distinction because higher credit risks, if they were occurring, and they're not, would be a sign of permanent impairment of capital. That means when you buy a bond and you hold a basket of bonds, the short-term volatility one experiences due to these changing interest rates is just that. It's volatility. It has very little bearing on the actual total return when that basket of bonds is held through to maturity. So the bottom line is this. I think with yields moving higher recently in most fixed income markets, the future return for bond investors from this point forward, well, it's likely improved as the reinvestment rate is going to be at higher, more enjoyable yields. In fact, we're actually seeing increased investment opportunities in a number of areas, especially on the short side of the curve, because it's short-term interest rates that have moved the most, whether that be in short maturity investment grade credit, whether it be in senior collateralized floating rate maturities. There's a number of options available for fixed income investors today. So make sure you stay intentional with your positioning on the yield curve, be diversified, and keep those bonds or that fixed income as that ballast inside of a well-diversified portfolio. I'm Craig Bolanos, the CEO and founder of Wealth Management Group. If you'd like to learn more, you can. Go to our website, investwithwmg.com.
Go to businessfirstam.com for where to see our show on TV.